So welcome everybody. My name is Olga Radionenko. I am the Executive Director of the International Association for Energy Economics. It gives me great pleasure to welcome you for today's webinar about the effects of the Middle East war in reshaping the gas and LNG markets. Thank you very much, Professor Almeida, for joining us and for moderating this discussion. I'm now giving the floor to Professor Almeida to welcome our moderators and to start the webinar. Welcome.
Hello, good morning, good afternoon if you're in Europe. So thank you, Olga, for organizing this webinar. I think it's a very important discussion to see the effect of the war in the gas markets. And we have invited here uh, three very important specialists on the gas markets. To discuss with us the effects of the war at the gas markets. So we have here most of you may already know Mike Fullwood um, uh, from Oxford, Andreas Schroeder, and Marcia Sensini from Florence School of Regulation, and they know a lot about the natural gas market, and they have been lately analyzing the effects of the war on the gas market, and I think it's a very good opportunity for us to learn from them what's going on in the market. So um, everybody's already already knows that the war is one of the most important disruptions on the energy markets in decades, and depends on how the negotiation will evolve. This could be the largest disruption on the energy markets since the first oil shock, and even larger than the first oil shock. Um, the public focus has been on oil, a lot of debates on oil, a lot of webinars on oil, but very few people has discussed it so far, the natural gas effect. Although the apparently, as compared to the oil, the disruption on the natural gas part of the energy chain in the Gulf has been much larger than the disruptions on the oil side. And not only because of the closure of the Strait of Hormuz, but also because of the destruction of some significant infrastructure in the Gulf states for LNG liquefaction. And this could bring some long term effects. Um, we have been in a moment in the LNG market where we have been expecting some uh, fast increase in supply. There were kind of LNG wave um, being um, uh, prepared, let's say, for the LNG market in the future. But now, with this disruption, we don't know exactly how the market can evolve. So I think this is one point to discuss looking forward. And this disruption will be different according to energy markets. If you are dependent on LNG important, like Europe, for example, or some European countries like Korea, like Taiwan or Japan, this can be very, very significant in terms of the impact on the energy market. So LNG it has very important interchange with other energy markets in the country. So it's important to see how this disruption can affect uh, the, um, the energy market in some area more dependent on LNG. Although negotiations are ongoing, and we see with some hope the recent agreement today in Lebanon. there is a lot of uncertainty, and in particular, a lot of uncertainty regarding the future status of the Strait of Hormuz. Will the Strait of Hormuz be open freely, like has been before the war? Will Iran charge some fees for the trade in the Strait of Hormuz, or will be this opening a kind of fragile opening where the risk of trading with the Gulf state will be very high and affecting the long term the LNG. So there are lots of uncertainty. So I'll start with a discussion better how bad is this disruption. I think that it's important for us to understand how the situation has evolved so far in the LNG market. So I will start with Mike Fullwood uh, to give his impression, and then I'll pass to Andreas and Marcia his impression on how bad is this disruption so far and how this disruption has affected the LNG markets so far, so that we then uh, can discuss looking to the future. So thank you, Mike, and the floor is yours.
Thank you very much, Edmar, for the introduction. Yeah, I'll talk a little bit about what's been happening mainly on the supply side, and Andreas is going to talk more about the demand side. So, as you rightly said, the closure of the Strait of Hormuz, which really began almost as soon as the US and Israel started bombing Iran from the beginning of March. I mean, that's very, very roughly speaking, these numbers have been used a lot, but 20% of the world's oil supply and 20% of the world's LNG. Now, obviously 20% of LNG is not 20% of the total global gas demand. So that's a very different order of magnitude. Plus, we're also losing access to some fertilizers, helium, and other key products, which may have longer term effects. But the sort of immediate impact on the, as you said, on the certainly on the price was that the spot prices shot up for gas more than maybe for oil. So we saw 60, 70, 80% increases in TTF and as the European price and JKM, the Asian spot price immediately. They've come back down a bit since then. So it's saw an immediate impact on that. So basically on the LNG side, what we've lost is it's not just Qatari volumes, it's also the UAE volumes, is the two countries, bit behind the Strait of Hormuz. The Oman facilities are not; they're more on the Indian Ocean side. So we've seen no real reduction in any volumes coming out of Oman. So UAE and Qatari together, the immediate impact was to lose roughly about 9.5 BCM a month, which over a whole year is 115 BCM, which is roughly 20% of the world's LNG supply. Now, the production shutdown was happened in the beginning of March, but for most of March, deliveries were being made from Qatar and UAE to Europe and Asia. So we only started to see the drop off in deliveries, sort of the third, fourth week in March, and in fact, I think there's still some residual cargoes being delivered at the moment, which were produced in February. So there's one I know arrived in the UK a couple of days ago, which had been left the Qatar facilities in February. Now, most of the LNG from Qatar and UAE goes to Asia. A lot of it to India and Pakistan. Quite a bit to China and all the big Asian importers. Qatar volumes to Europe have been declining in recent years. I mean, there's contracts with Italy, with Poland, some goes into Belgium, into Spain, and also into the UK, but those volumes have been a lot lower recently. Also, two of the Qatari trains, which amounts to roughly sort of 10, 12% of their, well, maybe a bit more, 15% of their output have been damaged by bombing. Now, the estimates vary between how long they may take to come back on. Maybe about 3 to 5 years was the estimate of the Qatar Energy CEO. And then in terms of the trains which haven't been damaged, in terms of bringing them back on, there's been a lot of sort of different information on how long that might take. It does depend on whether they've been warmed up, i.e., you've warmed them up very slowly. if you need to cool them down again, then that could be 5-6 weeks before that can happen. If they've not been warmed up, then they could come back on quicker. So there's a bit of uncertainty about that. There were some reports that a couple of days ago that they were actually beginning to cool them down again, but that I don't know whether that's true or not. So even if the Strait of Hormuz opened, it could take a month, 6 weeks before we go back up to full production on the undamaged trains. Then also Qatar has expansion trains. The 6 big trains been taken final investment decision with 2 more. Now the first one was supposed to come on towards the end of this year, but it seems quite likely that work has stopped on that. That'll get pushed back to 2027. Then all the expansions get pushed back by a quarter or a couple of quarters, depending on when the strait reopens. So we have done some modelling at the OAS on the impact on price and demand. Maybe we'll come on to that when we get onto the looking forward bit. We did a comment which came out a couple of weeks ago, so we can talk about that later. So I think overall, if the strait reopens, we're not going to see Qatar and UAE LNG, so other than the tankers which have been trapped in there coming through the strait and delivered to markets. So even if it opened sort of next week, it will probably be it could be middle of June or later before we see significant volumes coming out of the Middle East to deliver to the market.
So very good overview to start to understand the real impacts on supply. So I will ask Andreas from ISIS to give his view on the impact, so how bad the situation is.
So we all know that Asia is most affected by the supply outage from Qatar due to the strong trade relations between Middle East and Asia. So they will have to bear the brunt of all of the supply shortage. And we do see that as far as we can in the data already. So China is already taking quite low LNG imports in March. They had already been low in February, honestly. And then there's other countries like India, Pakistan, Bangladesh responding as well, where you see only limited purchase of spot cargoes or so. And we're expecting quite significant shortages in those countries as well. We are talking of in the order of 30% cuts, 30 in China, India. We're talking even stronger cuts in terms of percentage for Pakistan, which is entirely dependent on Qatari LNG so far. And yeah, but the surprising thing is that during March, countries like China, which are importing a lot, they even resend cargoes to the market. But that's a situation that is over now. Given that, as Mike pointed out, the supply comeback will last longer, and to bring this back to full operations will last at least until summer. So China cannot afford to resend cargoes to the world any longer. To me, noteworthy is the effect we're seeing on Europe. So the most immediate demand reaction can be observed in Europe. That's where we have a lot of data transparency. That's where we see daily data from the power sector, so we can study directly the effect of higher gas prices on the power sector, and we've done analysis around this. And so here we're talking of an effect of certainly somewhere between 10 to 20% of the gas demand drop due to the power sector. Yeah? So the power sector immediately reacting to this with fuel switching towards coal or lignite, especially lignite-fired power plants, as well as nuclear, which are now deep in the money, whilst gas plants are not in the money any longer anywhere in the forward curve. Therefore, this switching is contributing to a lot of cuts on the demand side, and we see lower LNG imports into Europe. But we will see the main effect of this materializing only in April and May. As Mike pointed out, the last cargoes have been arriving into Europe last week. So it's only as of then that we see the real effect of the closures.
Thank you, Andrea. So there's a lot of mitigation, short-term mitigation and adaptation. I imagine that the stakeholders, and they have been trying to mitigate, hoping that the war finish rapidly, so that and then we come to the normal. But this has a short-term effect. Yeah, very good to understand that. So let's pass to Marcia to give her view on the situation before we talk about the future.
Thank you, Elmar. Thank you for having me. So, building on what Mike and Andreas were just describing in terms of supply and demand, I would take a slightly different angle and focus on how the European gas system has changed. I think because this really helps explain why we observe such strong price responses, even in the absence of large physical disruptions. And so before 2022, a large share of the European gas supply was organized around relatively stable bilateral relationships, in particular pipeline imports from Russia. So by 2021, that accounted for roughly 45% of EU gas imports. And so infrastructure and contracts and procurement strategies had evolved around these long-term fixed corridor arrangements. Since then, the system has reconfigured quite significantly. So Europe has decreased the reliance and the dependence on the pipeline from Russian gas. We are seeing a phase out by 2027. This has been counteracted by a rapidly expansion on LNG imports. We had an improved resilience of physical supply, but that has also changed how the system operates. So before, the dominant risk was linked to physical disruption along these relatively concentrated supply corridors. In the current system, supply is more diversified, but it really also more depends on global LNG markets in particular, where gas is allocated through price signals, through logistics, to competition across regions. And so the key point is that the system is not less exposed, but the system is exposed differently. And so this really helps, I think, explain a bit more the current situation that Europe is experiencing. So the scale of the physical disruption that's linked to the Middle East is relatively limited. We are talking about, if I remember correctly from OES recent paper, around 20% of the EU gas supply. And price have risen to around 60 euro megawatt hour at the TTF, recent numbers, which is more than double the pre-crisis level. But if we look at during the Russian energy crisis, the physical exposure was much larger, as I said, around 45%. But the the relationship between the physical disruption and the price was not proportional to the price rise that we see today, if we go look at the number. So this suggests that in a globally integrated LNG market, even relatively modest supply risk can produce larger price effects, even when we have an aggregated supply demand that remains sufficient. So the reason is that now gas is mostly allocated through global competition, and so it's not only a function of the disruption itself, but how the system transmits this disruption. This really fundamentally changed the way in how risk materialize.
Excellent, Marcia. Thank you. Yeah, so two messages. One, Europe has learned, let's say, for the first crisis in Ukraine, and due to these changes in Europe, in the way the market works, Europe has been able to mitigate better the disruption, and then that the idea that the global system is more able to absorb disruption than if you are in bilateral relations. So this view of the global market as a way to improve the resilience of the to disruptions is very interesting. Okay, so now we can move. Now that we understand what's going on in the market, let's move to think about the future. And yes, there is some hopes, and let's say that the American government has been very successful on selling the hope of the war being resolved very fast. So we are always about to end the war in 2 days or 3 days, and this is not happening. But yes, there is a chance. Let's say that the war uh, ends and there is some kinds of agreement, either ceasefire or peace agreement. So one thing that we can think about is what happens to LNG markets if there is some peace deal or agreement and we resume the trade through Strait of Hormuz, and what would be the impact on this kind of benign scenario. Of course, that there is a lot of uncertainty about what will be the status of the Strait of Hormuz after this agreement. But then there is another, let's say, pessimist scenario where somehow the situation stays fragile or the war delays to end, and we have more significant disruption. So, how this could affect the world LNG markets? I'll start now with Andreas, and then I'll pass to Marcia and Mike. So, Andreas, can you give your view looking forward to the future?
Thanks for your question. It was already alluded, there are some logistical challenges. Once you open Qatar LNG, once you open the Hormuz Strait, there's so many ships lying around somewhere else in the world, they will need time to come back to Qatar, to be filled one after the other. And also, the facility Ras Laffan itself is partly damaged, and it would need to ramp up again, might need to be cooled down even after some months of non-operations. So that takes time. Therefore, our belief is the base case view is a 5-month closure of or disruption, let's call it, of the Qatar output. Yeah. Even if there is a ceasefire now, it will take a long time for all of the capacity to be back. There can be a gradual ramp up, of course. And of course, there's also 15 ships currently trapped in the Hormuz, so that you could release them immediately with short time only. The longer term problem is the expansion of Qatari LNG. The vast expansion that was planned for the end of this year is now to be delayed. So we delay this to summer next year. And that means there's less supply for next year included. No matter when there's a ceasefire, irrespective of any deals that you conclude now, we delay the whole expansion. And that has implications for the oversupply as well that we're expecting on LNG markets long term. So the narrative before the war was clearly there's a huge wave of supply coming to LNG markets. We still believe this, that's still the narrative, but it's going to be slightly shifted towards the later horizon, but then it will come still. So the additions that we see on the global LNG market, especially from North America, they are just so massive, they can even offset the effect of missing Qatar volumes for a few months.
Right. So, Marcia?
Yes, thank you. So, if we look at the consequences for the European market, but in the short term and looking ahead, there are a few main dimensions that I think should be highlighted. And so in the short term, the key issue is, I think, the interaction between the storage requirements and the global market condition. So we are entering a refilling season with the storage level that are significantly below historical average. I believe it's like around 20 to 30%. compared to a 5-year average of roughly 40%. So at the same time, there is also this regulatory requirement that was put in place during the previous crisis and that still remains to reach around 90% of storage levels ahead of winter, although the framework has been a bit relaxed in terms of timing and compliance, it still remains. And so this creates large and time constrained demand for gas. And so this tight LNG market does not really imply physical shortage, but intensifies the competition for the cargoes, as we say, and amplify the price pressure. So even though storage, I believe, remain a key stabilization instrument, and we've seen it with in the past with other supply shocks, I think in this context it becomes a source of demand pressure. And so Europe is not just passively exposed at this moment, but with this storage policy and the policy that it had put in place is really actively creating a bit of a demand pressure at the moment. And so I think this translates, if we look at it from a broader perspective, into a system where access become the key variable. So the question is not longer whether we have a shortage or whether we have availability globally of gas, but whether Europe can attract this gas under these competitive conditions. So as also Andreas was highlighting, we are observing adjustments in the system that do not only happen on the supply side but also on the demand side. But these adjustments are distributed unevenly across regions. So we have a significant part of this adjustment taking place in Asia through demand reduction or fuel switching, which really shapes the overall market balance. And so the system is becoming more globally synchronized and increasingly price-driven as LNG has been more and more deeply integrated into the market. And we've seen this with the new 21-hour trading window for the TTF that just launched, I think, yesterday or tonight. So policy is really now operating under more explicit and binding trade-offs than it was before. And so I think also this was mentioned before, and we are not just seeing exposure on gas, but also on electricity. So electricity system where gas still frequently sets the marginal price. These global gas dynamics are really transmitted directly into the power prices through this merit order. So we're not looking into how to secure volume per se, but how system organize around these new global markets in transmitting the shocks into European prices, and then through those into the industrial competitiveness, inflation, and the broader economy.
Thank you. So now, Mike.
Yes, thank you, Edmar. Thank you, Marcy and Andreas. Yeah, I referred earlier to the fact we'd done a comment or a note on modelling the impact of successively longer closures of the Strait of Hormuz. So I would caveat that first of all by saying the world's not going to run out of gas. The lights aren't going to go off generally around the world because 20% loss of world LNG is only a 3% loss of world global gas supply. So that's very different to oil. Losing 20% of the world's oil could actually lead to real shortages. But so that's the sort of the caveat on that. So in terms of the modelling, we looked at 3 different scenarios. One is called a 3-month closure, which means deliveries probably would not start until July. Then a 7.5-month shutdown where deliveries don't start till mid-November. Then a 12-month shutdown where deliveries don't start until April next year. So in terms of the modelling, there's obviously a demand response to higher prices built into the model, and the sort of region is losing the gas LNG is Europe, India, China, Pakistan, Bangladesh. On a pricing terms, to a lesser extent, Japan, Korea, Taiwan. But I think what we've seen, and Andreas talked about, was more a bit of a policy response to just save gas and reduce demand there. Now, in terms of the impact on price, I mean, very broadly, pre-Hormuz closure, we were in sort of $10, $11 per million BTU world, which is around about 30 euros a megawatt hour. In terms of the not coming back on until July, then the average price for 2026 will get to about $30.50 a million BTU. In terms of which is roughly 40 euros a megawatt hour. In terms of not coming back on to mid-November, then the average 26 price will be $21 a million BTU, which is just over 60 euros a megawatt hour. Then a full year's closure, then the model shoots the price up to $34 a million BTU, which is 100 euros a megawatt hour. Now, that is very comparable with the impact the Russian invasion of Ukraine had on TTF prices during 2022. So we're pretty much losing a similar amount of supply as we did from the loss of Russian pipeline volume. So that's orders of magnitude. Now, where the forward curve is at the moment, I think it's come off a bit in the last couple of weeks, and certainly from the initial reaction, we're only about $14, $15 sort of forward curve now, which suggests that the market may be expecting that volumes will come back on in late June or July in terms of deliveries. So that will be that, which the market could be underpricing the risk of those sorts of things happening. Now, the other side of the equation is that the LNG wave has started. We're seeing bigger waves arriving on the beach, or we were until the end of February. So we were looking at, in terms of a year-on-year increase from new projects and also last year's projects ramping up, like Plaquemines, about a 50 BCM rise in supply coming on, with very little of that coming from the Qatari expansion. So that is about 5 months worth of the loss of UAE and Qatari volumes. So if the market's believing it's going to come back on, having just lost 3 months' volumes, then they probably are pricing it correctly. But if negotiations fall apart and it doesn't, come back on, then I think you could see a correction to prices if there's a belief that this could drag on for most of the rest of the year. Just on the LNG wave, Andreas talked a little bit about that, and you've mentioned as well, Edmar, that if we assume that in the worst of all possibilities, they didn't come back on for years, nothing came back on, then the amount of US LNG and other LNG around the world coming on would mean that by the end of 2028, we would have replaced completely all the lost Qatari and UAE supply because of the new projects coming on. Obviously, in that time, we've lost a lot of demand, but the supply would actually been completely replaced, the 115 BCM a year loss. So by the end of 28, we were back to what the February levels of capacity were. And obviously, the capacity is going to increase from then. But the LNG wave will be a lot less because we're losing all the Qatari expansion trains, which are a big part of that. So in summary, I think the market's looking maybe at a 3-month sort of hiatus to Middle East volumes. If things go bad, then we could see prices spiking up again.
Thank you, Mike. So a lot of uncertainty regarding the future of the prices, but I would like to bring you to a reflection on the long-term effects. With price, we never know. Prices are very uncertain to understand, but we can say that, let's say, the geopolitical risk of the Gulf and Qatar and the Emirates will not be the same, even if we get an agreement, because there is always this risk of the new disruptions and a lot of instability in that region. And so maybe this could play a role on the LNG geopolitics, let's say. There is a lot of countries that are in the queue to have FIDs and try to get into this market. Like I could mention, for example, a lot of potential in Mozambique. There are big projects there. There are Argentina that is trying to get deals to be part of this market. Can you see any effects on bringing new actors to the LNG supply in the long term? Um, do you think that the long-term prices could be an incentive for FIDs in different regions due to the geopolitical risk of this part of the world regarding LNG supply? So I start with Mike again, and then I'll pass uh, to Andreas. Is your view on the long-term effects for LNG?
Okay, just in terms of the supply side, I'll talk a little bit more about the long-term effects after that. But I think we're going to see, these are going to probably happen anyway. Probably 3 FIDs, final investment decisions in the US in the next couple of months. That's Commonwealth LNG, Texas LNG, and Delfin LNG. Delfin's a floating LNG. So they were going to be taken anyway. I think on a longer term impact, then it will certainly give some encouragement to more US, more Canadian FIDs, possibly the Rovuma project in Mozambique, additional Mozambique trains, even Tanzania, possibly expansion Senegal, Mauritania, Tortu, Papua New Guinea. There's a lot of potential projects around there, which even more in Indonesia, for example, which could, with the available gas supplies, sort of add to it. I think in terms of longer term outlook, it kind of depends how long it goes on. So if it all got resolved and we were back online by July as in our sort of 3-month closure scenario, then the market forgets about these things very quickly. If it came back on next week, the market had forgotten about it in 2 weeks' time. So the market has a very, very short-term memory. I think the impact on demand, and Andreas may want to opine on this on the demand side, but the longer it goes on, the more of a threat it might be to long-term underlying gas demand, especially in the Asian markets. The Asian markets are the ones who are going to soak up a lot of the LNG wave, but they may go down a different path, whether that's renewables or just more coal. I mean, that's what's happening at the moment. We're getting more coal, so that could undermine the long-term demand outlook. My view is I don't think that happens so much if things get resolved very quickly. But if it's still off this time next year, then I think you've got a fundamental underlying threat to longer term demand. But I think Andreas may have views on that as well.
Indeed, yeah. So
Yes,
indeed, so what we will see is supply growth as effect. So a few more FIDs. Mike has mentioned 3 in the US, but then I see some potential for Africa as well, where there is development projects waiting, and I'm talking specifically about Senegal, but Mozambique as well. And Nigerian supply has been not so reliable in the past. But this is something that we see, so a bit more supply growth. But then on the demand side, that's interesting, and that's the huge unknown. So what will be the long-term effects on demand? And naturally, the most obvious choices now for European demand and for Asian demand will be to go increasingly for renewables and electrify some of the demand. That would mean accelerated energy transitions would be the answer. And if that's the case, I would see clearly a downside risk for demand. And then also there's another aspect to consider, risk premium on LNG prices. Now, from now on, LNG import dependency will be perceived as something not reliable, given the geopolitical risk. And the answer to the last crisis 4 years ago, the Russian-Ukraine crisis, was a dash for LNG. So now we're feeling the downside, so to say, the risk of LNG unreliability. And every crisis has its own response, and I think potentially this will lead to further acceleration away from gas demand towards other solutions.
Thank you, Andreas. Marcia, your view on the long-term impacts, please?
Yes. So, well, I mostly agree with what Mike and Andreas were just saying. And so I think that the uncertainty on price geopolitics and politics can really delay FIDs and well, certainty is really what really drives investors. And so this environment so volatile might not help. And in that sense, as already Mike was mentioning, it really needs to be see how long this is going to last. And so under what condition I think this long-term capacity will be built. I think it's another issue that really needs to be seen. So is the system going to be able to generate the right system to support the signals and for investment? So yeah, we are seeing a change on how gas is traded for Europe and also how this triggers investment.
So I'll have one last questions, and if let's see if there is any question from the audience. But I would like to see your view and on the possible impacts for the LNG trade. We see that the spot market has been increasing, or have been increasing the last decade, let's say, and in Europe with the a lot of new trade of LNG has been in the short term because of the need to adapt to the Russian crisis. But the risk of supply drives people into long-term contracts. So how do you see this crisis playing out regarding the evolution of the LNG trade more into spot market or more into long-term contracts? I'll start with Marcia. I mean, if she has a view on this, is this affecting anyhow how people trade LNG? You're in the mute, Marcia.
So sorry, I would not really frame it as a choice, right, between spot market and long-term contract, but rather as a rebalancing between flexibility and security. So like long-term contract have traditionally played a key role in underpinning investment and in providing supply stability. But at the same time, we have spot and short-term markets that have become increasingly important in a system that is more, as I said, more globally integrated and need to really adjust to this changing conditions. So I think the challenge going forward is how to maintain sufficient long-term signal to support investment, but also preserving the flexibility needed that to operate in a global LNG market.
Thank you. Andreas, do you have a view on this?
Yeah, so traditionally, Europe has secured all of its net imports through long-term contracts, in majority from Russia and Norway. That was over since 2022, and we entered into a phase where Europe was under-contracted, let's say, and a lot of spot LNG was taken since 2022, and we are now in the situation where around slightly more than half of European net imports are covered through long-term contracts, but the rest is taken via spot. And European off-takers have difficulties to secure new deals because of the contract conditions which Qatar and others want to impose, like very long durations, fixed destination clauses, and so on. This is something that Europeans, with their climate agenda, do not want to commit to. And so a contract the inflexibility of contracts is something that is impeding us currently from signing new deals. Nevertheless, German government and others are pushing now for more stable LNG supplies, and also this will help stabilizing the import capacity utilization. I want to stress another fact. One implication of the crisis now is that the spreads between continents are diverging again. So the East Asian prices are way above the Europeans now. So there's a bit of divergence. But long term, the effect will be likely a convergence of continental prices. This is what most analysts agree. Henry Hub plus transport costs will be the basis of long-term supply costs. And then in such a world, which is completely different to now, in 2 years' time, in an oversupply world, long-term contracts are not that much necessary as they would be in this situation of crisis.
Thank you. So, Mike?
Yeah, I think basically we're moving to a world of more spot and less contract. Although there's a very grey area. Is you need long-term contracts, for example, to underpin pretty much every US LNG export terminal in terms of a 20-year contract. That's a long-term contract with a portfolio off-taker. That's not a long-term contract for a buyer in an end-use market. So I think we're going to see much less long-term contracts for end-use buyers in Japan and in Europe, but you still need the contracts to underpin the projects. I mean, fundamentally, long-term contracts don't help you in a shock scenario. It obviously, long-term contract with Qatar is no use at the moment because they're not producing. A long-term contract didn't help Pakistan in 2022 when the long-term contract providers pulled the contract. So we're moving more and more towards a world of more spots, more portfolio players, a lot more hub pricing, which has been rapidly increasing, a lot more flexibility. I think what the market has shown in the 2020 COVID period and 2022 Russian invasion of Ukraine and now is the huge flexibility we have in the market. And that saved us in 2022 when we lost the Russian pipeline gas and we're going to get more LNG into Europe. It doesn't bear thinking about what the consequences of that Russia invasion shock in 2022. If that had happened 10 years earlier, then we would have had widespread power cuts in Europe, lights would have gone off and people would have died from the cold weather. So the flexibility of the LNG market saved Europe a lot in 2022. I think we're going to see that more and more. The requirement, as Marcy said, and Andres said, for more flexibility in the way LNG is traded around the world.
Excellent. So yeah, very good to learn how the market is adapting well, let's say, to this disruption. I see one question here. Uh, we are about to end of our time, but I think we can try to answer this question, and then we go to the closure of our webinar. So the question from Natalia Rodriguez is: how do you see any risk of physical constraint in global LNG supply in the short term this year, particularly affecting South America, or is this more likely to be a matter of price premiums of secure cargoes? Is anyone?
As a matter of fact, we are already observing pretty harsh cuts in Asian states. If the government is enforcing into all government buildings, take Thailand, for instance, policy-driven closure of cooling sites of government buildings. So those are very harsh demand response measures to cut supplies, and Pakistan is feeling those shortages as well. So you could say it's already felt by some people, but overall it's a matter of spreads and a matter of prices again. So if South America is in need of cargoes, it will US cargoes can divert to Argentina or elsewhere and deliver those cargoes. And if the spread is attractive enough, they will do so. Really.
Yeah, I think I would agree with Andreas. I think what we're seeing is a policy response to curtail demand, but that's not a physical shortage where you just simply things don't turn up and you have to start rationing. We're not really at the rationing stage yet. I don't think we'll ever get to the rationing stage in gas, but we could easily get to the rationing stage in terms of oil and gasoline and oil products, given the magnitude of that. So, yeah, there's a governmental response to reduce demand, curtail demand, which kind of makes a lot of sense, which we saw in 2022 as well. But we're not going to run out of LNG where we have to have rationing and power cuts.
Any thoughts on that, Marcia?
No, I think they pretty much summarized it very well, and also like my focus is more on European markets. So
Right. So I think we are coming to the end of our webinar, and I would like to thank the participation of the three very uh, prepared, let's say, speakers for the LNG market. Thank you, Marcia, Mike, and Andreas, for your time to share with the IAE audience and members your knowledge about this market. And I have learned a lot, and I learned that. Market is playing a very important role in this in the adaptation to this disruption. A lot of mitigation through demand destruction or demand shift towards other sources. So this is a characteristic of gas, right? As compared to diesel, for example, where you have to rationing or aviation fuel. So you don't have any other choice of instead of rather than make a rationing. But in the gas case, there is policy that can be effective on reducing demand. So this short-term mitigation is playing an important role for minimizing the effects in the short term. But looking forward to the future, everything will depend on how the market come back to normal or to the new normal. I would say I don't think we will have a normal, our old normal. So we're gonna have a new normal. But anyway, this new normal will bring some long-term effects. We have been discussing here the fact that prices can be higher for longer until the normalization of the supply. Could be an opportunity for new players in terms of FID. A lot of new FID in North America, which would not represent a large diversification, let's say, from supply in terms of LNG supply, but there are some opportunities for Africa or Latin America, for example, or even Indonesia to give FID to new projects, and by this create some more diversification in terms of supply. And yes, I think in another message is that the LNG market it's working, and uh, the Marcia give this view that the global market is much more resilient to disruption than bilateral trade through, for example, pipelines. So in this regard, at least Europe, it seems to be in a better situation than it used to be before the war in Ukraine. So that was my what I learned, let's say, and maybe I'm not a very good student, so maybe I didn't get anything, but everything. But I think that was in my view, the main message that we could see from this webinar. So thank you very much, and I hope to see you in Chile in the international conference for IAE, if not in other events of IAE. Thank you very much. I'll pass back to Olga to close the webinar.
Thank you, Professor Almeida, for moderating this webinar, and to our speakers for joining us today for this discussion. The recording of this webinar will be available on our website and also on the association's YouTube channel. So thank you all for attending. For those of you who are not members of IAE, you're all welcome to join us via our website. And for now, officially, this webinar is closed. Thank you all. Goodbye.